Hello and welcome back to All Things Money. My name is David Blain, and during this segment we're going to be talking about some of the myriad of tax law changes that took place in 2010. This time of year, people busily filling out their IRS forms or getting their information together and taking it to their tax preparer to prepare their taxes for them. At my firm, we do quite a bit of tax preparation work. We like to do the tax planning, we think is much more important, and we do tax planning year-round, and so it's natural this time of year to actually fill out the forms. But when I tell people, if you're doing your tax planning here in February, it's a little bit late for 2010. You should have been doing it last February. So what we're doing today is recapping some of the laws so that you can file your taxes correctly, what we call the compliance part of tax work. The more important part, we think, is the tax planning portion. So we're going to try to mix in a little bit of the tax compliance, what you need to do to be in compliance with the law, as well as some tax planning, what may help you in the future. So when we left off last week, we were talking about a nifty little deduction that was brought up for 2010 for self-employed taxpayers. If you receive your health insurance from work, if you're an employee, that benefit is given to you tax-free, meaning free of income tax and free of Social Security and Medicare tax. Well, a self-employed taxpayer, someone that works for themselves, the rules for health insurance are very different. But one of the basic rules is that the premiums that a self-employed taxpayer pays are an adjustment to income, meaning that they don't pay income tax on the value of what they paid for their premiums. However, through a little quirk in the rules, they were subject to self-employment tax, which for a self-employed taxpayer is approximately 15.3% of their self-employed income. So this created a little bit of a dichotomy between self-employed taxpayers and people that receive their health insurance through a larger employer. So in 2010, Congress adjusted this such that a self-employed taxpayer will not owe income tax or self-employment tax on any health insurance premiums they may paid. So that's, I think, a good break. The same thing with for the break on Social Security tax. If you recall, there's a 2% break for employees on their Social Security. This also applies to self-employed people. A couple things that were not renewed, which is important as some of the breaks that were. The first-time home buyer credit, which was up to a maximum of $8,000. The tax credit has expired for most taxpayers, for just about everybody. And they did not renew it. For those of you that are unemployed, unfortunately, the 2009 Act allowed you to exclude $2,400 in unemployment benefits. This provision was not renewed for 2011 or for 2010 or 2011. So if you received unemployment benefits, these are fully taxable, which it's... When you think about it, the way unemployment works is if you earn a salary, your employer pays into the employment system of both the state and federal government, and depending on the employer, it's a different amount. Our unemployment tax rates run in the 3 to 4%, but I have seen businesses up in the 6-7% range, and so they pay a tax into the system. Then when the employee or the person that was laid off receives these benefits, they are also taxed on it. So the popular energy tax incentives for individuals renewed at the end of 2010. The energy tax credits have been a very confusing area of the code, but generally applies to things like solar panels, geothermal systems, energy efficient windows, doors, insulation, things like that. I'm not going to go into all the details of those, but the majority of them were extended for 2010. A couple of impacts on businesses. Several of the next topics are going to be about businesses. Congress used the 2010 Tax Relief Act to double and extend bonus depreciation from 50% to 100% of qualified property placed in service before January of 2012. And so what this means is that in addition to, there are ways to expense items in the tax code. Section 179 has always allowed businesses to expense a certain amount of items, but this bonus depreciation, which they enact from time to time, I remember after the September 11th terrorist attacks, they also enacted this bonus depreciation. Essentially, if a business buys, let's say a truck, let's say they're in the construction industry and they buy a big backhoe or something, and it costs $100,000. Well, machinery and equipment like that is typically depreciated over a 7-year period, what's called the useful life of the equipment. And so even though the business owner spent $100,000, they cannot typically take that full tax deduction in the year that they spent it. So what bonus depreciation and Section 179 expensing do is it allows that business owner to deduct the full amount, $100,000, of the equipment they bought in that year. And so it allows them to take the deduction for all the money that they spent. It can be a very good deduction for business owners because they spent the money, but under normal depreciation rules, they would have to take that deduction ratably over a number of years. And so it really helps reduce the taxable income and encourages businesses to purchase equipment. Okay, well, we're running out of time for this segment. When we come back, we will continue covering some of the tax law updates that affect you and your family. For All Things Money, I'm David Blain.